My guest today is Professor Itay Goldstein, who's Professor of Finance and Economics at the Wharton School of University of Pennsylvania. His research interests include feedback effects between financial markets and real economy, financial fragility and crises, financial institutions and markets. Welcome, Itay.
Thank you. It's great to be with you.
Yeah, thanks for coming back. We talked at the height of COVID 3 or 4 years ago.
That's right.
But I have a very interesting paper that you sent me, AI-powered trading, algorithmic collusion, and price efficiency. So you say here the integration of algorithmic trading with reinforcement learning, termed AI-powered trading, is transforming financial markets. Alongside the benefits, it raises concerns for collusion. This study first develops a model to explore the possibility of collusion among informed speculators in a theoretical environment. We then conduct simulation experiments replacing the speculators in the model with informed AI speculators who trade based on reinforcement learning algorithms. We show that they autonomously sustain collusive, super-competitive profits without agreement, communication, or intent. Such collusion undermines competition and market efficiency. We demonstrate that two separate mechanisms are underlying this collusion and characterize that each one arises. This is a problematic observation, Itay. So we have all these AI things going on, AI agents. They're doing all sorts of stuff. In the financial markets, they're trading, and they are pattern-seeking mechanisms. As I mentioned in the email, I have some experience with this from when the dinosaurs were roaming. So they are pattern-seeking mechanisms, and when they are in the system, there are a lot of pattern-seeking mechanisms in the system. Without an intent or without communication, they could be following trends in some way that could potentially be problematic, right?
Yes, in general, that is correct. Yes.
So I'm interested in the policy and regulatory aspects of it, but let's get into the depth of this. So let's get some definitions. So what do you mean by algorithmic trading with reinforcement learning?
Right. So, we had algorithmic trading for a long time. I think what is unique to the AI, or at least the way that we are thinking about it, is the element of reinforcement learning, whereby the algorithms are not told what to do, but rather they find their own pattern, they find their own strategy, and they learn over time what is the best thing to do. So reinforcement learning is a fundamental element in artificial intelligence. And essentially, the algorithm is going to start not knowing anything about the environment. You can think about it as if they have this huge matrix where on one dimension of the matrix is the state of the world. The other dimension of the matrix is the action that they take. And then they are gradually updating all the cells of the matrix, what they should expect to get for a given action in a given state. And they just update over time. They try different things and they learn, and then they find out what works best. So that's sort of a long definition, if you want.
Yeah, so that's the idea. As I mentioned, Itay, so I was doing some stuff like this in the early 2000s, and the objective function was alpha, not returns, because we were, like academics like you, we were told that returns don't matter anything. I mean, if you buy a high beta stock, And the next day, some good news comes out for high beta stocks, and the stock goes up, and you make a bunch of money. That doesn't mean anything. And so the only objective function is alpha. So are these things really tuned to create alpha or profits? What is their sort of objective function?
It can really go both ways. It can be alpha, risk-adjusted alpha, profits. You can really define it however way you want. I don't think
Yeah.
that the key conclusions that we have in this study are going to change based on that definition of
Mm.
the objective function. Um, we kept it simple in terms of the
Yeah.
objective function, and we did it in purpose because our goal here is really to understand not just the workings of one algorithm that is operating against the market, but rather the interaction across different algorithms and the kind of equilibrium they end up converging on. So we paid
Yeah.
less attention to that dimension that you're mentioning right now, whether it's performance or return or alpha. We really want to think about what happens when you throw into a market environment a bunch of these algorithms and they trade against each
Yeah.
other. What kind of equilibrium they end up converging on.
Bunch of this algorithm. So if you read back 30, 40 years, these were humans, and humans were sort of trying to do it also, right? In some ways, no?
Yes, that's an excellent question. The question is it something that is unique to AI reinforcement learning algorithms or something that humans have already been doing? Um, there are many ways to think about it. I will
Yeah.
say that the most straightforward answer that I can give you is we can show that AI reinforcement learning algorithms are doing it. Showing that humans are doing
Mm.
it is going to be a lot more complicated because the kind of experiment that we
Mm.
have been running here with the reinforcement learning algorithms is not something that you could do easily with humans or not to do with humans
Mm.
really with any stretch of the imagination because running this kind of experiments with
Mm.
humans will be, I would say, close to impossible. So when it comes to
Mm.
humans, we can look at market data, we can try to infer from market data, we can ask them. It's going to be a lot more complicated to tell whether humans are doing it or not. I will say that in general, when regulators are thinking about collusion behavior with humans, they would typically look for some kind of communication, emails being sent,
Yeah.
meetings,
Yeah. Yeah.
something that anchors the expectation and gives you a good reason to believe that humans are indeed coordinating. I think what is
Mm.
quite striking about the AI reinforcement learning algorithms is they are clearly not communicating, they're not sending
Yeah.
emails to each other, they're not coordinating their behavior, but they somehow
Yeah.
independently learn to converge to this behavior where, in the end of the day, they achieve this collusive profits.
Yeah. So let me ask you this, Itay. So um, I haven't looked into this for like 10 years now, but my understanding is there's about 15, 20 million day traders in the US. I mean, human day traders. And um, I would imagine they have some sort of pattern finding mechanism in their brain, stocks going up, stocks going down, whatever. I don't know how they do it, but they're not sitting in front of their computers and doing this. They're not communicating. They haven't called anybody. But then they say, well, the momentum in XYZ stock, something that I should trade on. That's sort of similar, isn't it? I mean, is it different?
Yeah, there are certainly a lot of similarities between
Yeah.
reinforcement learning algorithms and humans. Because if you go and think about the way that humans are making decisions, there are a lot of theories about that in decision theory and economics. But certainly, reinforcement learning is one way by which humans are evolving and learning how to think and finding their optimal behavior. So
Yeah.
I don't want to create the impression here that reinforcement learning is something that is completely different and completely separate from how humans behave. As I said, I think what we can do with 100% degree of certainty is to run this experiment with reinforcement learning algorithms and show that they end up behaving in this collusive way. And I think that this by itself is a very important finding. Whether humans have done it before or not, I think that's a separate question. And I think that this is something that will be much more difficult to answer. But I think that with these very simple reinforcement learning algorithms, what was striking to us is that they find ways to collude, and they find different ways to collude. And they do it in a very pervasive way, really. I mean, if you think about the different ranges of parameters of the different aspects of the environment that we were looking at, really for the vast majority of parameters, they end up colluding. And that is something that we find very striking.
That's really striking, Itay. So from a regulatory and policy perspective, if you say, if you're sitting in Utah and, sort of trading with $100, okay, you're not on the radar. But then if you're a hedge fund deploying AI machine, so to speak, you might be on the radar in some way because the patterns that you reinforce, so to speak, have systemic effects on the system. And so going back to the policy and regulatory questions here, is it sort of financial fragility that we are really worried about in this process? Or as I mentioned, I ran a small hedge fund very early in this process, a factor model that was reinforcement. It wasn't sort of reinforcement learning as we call it now, but it learns from its mistakes, it corrects it, it changes the factors, it trades again, all autonomously. It did pretty well for 4 years, and then 2008, it completely crashed. And so what I'm worried about in this whole thing that's going on today, it's the fragility. It's sort of the systemic risk issue. Is that something that you're worried about?
That's an excellent point, and this is in fact something that we are now working on as a follow-up project. So just to say, maybe I'll take a step back and
Yeah.
put it more generally, kind of a big picture view. When you're thinking about reinforcement learning algorithms in financial markets, the first order thing that we wanted to understand is how they interact with each other, meaning not just one algorithm playing against the market, but once there are a bunch of them out there, what ends up happening in the interaction between them. But when you're thinking about this interaction, again, there are many different things that you can think about. So we started with the question of collusion. And collusion is important. People worried about collusion from the early days of financial markets. Collusion limits competition, limits liquidity. So we wanted to see whether collusion arises in this context of financial markets. I should also say that when people talk about AI algorithms outside financial markets, the question of collusion often comes up. So we wanted to take these AI algorithms into the financial market and see whether collusion indeed emerges. And as I mentioned, we did see quite pervasively that collusion emerges And indeed, we see that they learn how to collude. It reduces competition in the financial market. It reduces liquidity and so on. Now, you ask about fragility. And that is something that we don't address directly heads-on in the current study, but we are now in the process of conducting a second study that hopefully will come out in a paper soon, in which we are asking this question about fragility. And in particular, what we are thinking about is bubbles and crashes, because when you're thinking about a financial market and the question of fragility comes up, bubbles form when traders continue to ride on the bubble, right? Trade in the same direction of the bubble. This leads to the increase in the bubble, but eventually, like all bubbles, it kind of comes down in a crash. And the question is, how are these reinforcement learning algorithms going to behave in this kind of environment where you have a bubble and you have a crash? Are they reinforcing the bubble or acting against the bubble? And that's the kind of thing that we are looking at right now and trying to understand better. My intuition is similar to yours. I think your intuition is this is going to reinforce the bubble because they learn from the past and they continue to do the same thing that supports the bubble. And as a result, this is why we will continue to see it. And my intuition is the same, but we want to understand it better with another experiment. Yes.
Yeah. So my intuition is exactly the same as yours, Itay. So but we don't know. I mean, well, we sort of know from 2008, I think. I mean, these were humans, and humans follow trends too. Humans are very good at following. I mean, we are this in many ways. And so they've replicated humans, as they say in artificial intelligence, quote unquote. We have replicated the human brain. I would imagine, I mean, if they have really done that, they will follow trends too. And that will become very brittle because everybody's following the same trend. And at some point, economics will dictate the trend stops and goes in another direction and everything crashes. So there's a system. So going back to the policy and regulatory question here, Itay, so you cannot prove these guys are colluding. They're artificial intelligence agents. But then couldn't we regulate them from a systemic perspective and from SEC or some agency like that?
So can you repeat that last question, because I did not hear it very clearly?
So from a regulatory perspective, we can't really prove an AI agent is calling some other AI agent at colluding, as as we have done in the past with humans. But then, could we regulate them from a systemic risk perspective? In some way, I don't know what the mechanisms are. I'm just asking the question. Yeah.
Yes. Right. Yeah. That's a good question. So as I mentioned before, I think with humans, the basic premise underlying the regulatory approach has been that it would probably be difficult for humans to achieve this kind of coordination without explicit communication. And this is why regulators typically looked for some signs of explicit communication when regulating this kind of behavior. What we show clearly with these AI reinforcement learning experiments is with these algorithms, there is no explicit communication, but they still achieve this kind of collusive behavior. So clearly looking
the same
for
result. Same result. Yeah.
So clearly looking for
Sorry.
this, So clearly looking for this kind of explicit communication is achieve this kind of collusive behavior. So clearly looking
the same
for
result. Same result. Yeah.
So clearly looking for
Sorry.
this. Yeah,
Go
so
ahead. Sorry.
clearly looking for this kind of explicit communication is not going to work as a regulatory approach.
Yeah.
So
Yeah.
the question is, how can you better regulate it? And I think the way to do it is to try to understand better what is making this kind of collusion easier to achieve, and then trying to regulate. I think this is what you mean in a more systemic way, trying to regulate such that the parameters of the market do not support this collusion very easily. And in our study, we do find some parameters of the market that would make it less easy to collude. And reassuringly, I think they are also very natural and very intuitive. So, for example, something that is very easy, and I don't think that people will have a particularly strong objection to, is just reducing the concentration of the market. So basically what we show is when you have more of these algorithms playing against each other, they find it more difficult to reach this kind of collusive behavior. So one thing that could be done by regulators is just requiring that the market will not be controlled by two or three or four players who are employing these algorithms, but rather have a wider base of these players, more entry, more algorithms playing with each other. Something else that is maybe not as strong in reducing collusion, but still has some effect, is the homogenization across the different algorithms.
Yeah.
So it turns out that when they are very similar to each other, achieving the collusive profits is easier. But when you start throwing in more heterogeneity, it becomes more difficult. So that's something else to think about. So I think, and this is something that you can learn from the experiments once you try different configurations, different environments, you see when collusion is easier to sustain.
Yeah, so there's sort of monopoly, duopoly question, which is if somebody has cornered all the resources in the world, that person can do whatever he or she wants, sort of. So if the process leads to concentration in some way, then it's a different world in the sense that you started with a time equal to zero position where there are multiple players, and then you have different algorithms and all of that. And over time, evolution or natural selection or whatever process that you have leads to two guys who is doing everything. At that point, you have no flexibility. It is so brittle that some little perturbation in the process could break them. So that's a systemic risk issue in my mind still.
Right. So you're saying basically just having a concentrated market where you have a small number of players who control the environment is in itself a systemic risk, which yes, I completely agree with that. And I think you will say this is true for humans, and it is true for reinforcement learning algorithms. And I agree with that as well. I think, again, what we can say with a high degree of certainty, given the experiments that we've done, is within the context of the reinforcement learning algorithms, having fewer of them makes it easier to collude. So I will say this goes on top of the other things that you just said. So if you said we should worry about having few of them just because then the risk is concentrated, I agree with that. But I will say on top of that, having fewer of them should also worry you because it makes it easier for them to collude, and this is going to further limit market competition, market liquidity, and so on. So that's how I would like you to think about the findings of our experiments.
Oh yeah, I mean, this is so interesting. So if an objective function as a society is to have more players, free markets, free competition, um, then how do we regulate this? Is it a capital constraint? Like, if a head gets $50 trillion in assets, it has to stop. I don't know what the right number is here. I'm just making this up. Um, is it a capital constraint, type regulatory constraint that we can put on funds?
Um, the question of why we end up with concentration and why we don't have market forces that allow for easier entry, I think is probably one of the most fundamental questions we have in economics and finance. And I would say there are many factors behind it. Interestingly, some people will tell you that part of the reason is regulation, because
Yeah,
regulation makes it difficult for smaller players to come in and
to enter
compete.
the market.
Yes,
Yeah.
and I think there is a certain degree of truth in that. Um, I think that sometimes you have natural barriers to entry because it requires a huge investment to get in and
Mm.
open your own shop and start competing. There is a certain degree of truth to that as well, but maybe in the context of a financial market, this is not the strongest factor,
Mm.
given that you don't need as much physical investment to come in and compete. Um,
Yeah.
so, if anything, financial markets are probably a little more open to competition than other areas of the economy.
Mm.
But those forces are really fundamental, and we see the tendency for concentration happening across different industry. The only thing I
Yeah.
would say is we see it very clearly in the context of this experiment that this is one fundamental factor that is promoting further collusion.
Yeah. So talk about collusion a little bit, Itay. So before the computer arena, because the AI arena, I should say, we could SEC and other regulatory agencies. What was that airline case? U.S. Air or something? U.S. Air called American Airlines and said, "Hey, we're going to fix the prices," uh, and they could get the recording of that. So humans are not involved anymore. So none of those techniques that we deployed in the past is going to work to unearth collusion, right? And that's a fundamental problem that we have. Yeah.
Yes, I agree. And again, I would say this is one of the key insights that we see from this study, because what is so interesting here is those algorithms are really very simple. We call it AI, but really the element of AI here is just reinforcement learning. And with this very simple element of reinforcement learning, you see how these players end up colluding with each other. So,
Yeah.
yeah, you don't need to call anyone, you don't need to talk to anyone. You just learn over time that this is the behavior that works out for you, and you do it.
Yeah.
So, yeah, whatever the regulatory approach has been for collusion, I do think it needs to be reimagined. Maybe it had to be reimagined a long time ago, but it certainly needs to be reimagined now when these algorithms are coming in, and whatever collusion we're going to find is going to be the way that they are colluding.
Yes, Itay, so just for the public, so can you talk a little bit about the Q matrix? So what exactly is reinforcement algorithms? I mean, how do they work?
Yeah. So I mentioned a little bit of this in the beginning.
Yeah.
These algorithms are coming into this game really not knowing anything about the environment. They only know what are the actions that they can take and what are the possible states of the world. And then they basically try to understand what is the best action to take in every state of the world.
Yeah.
They start off just kind of exploring and trying different things and updating the matrix. As time goes by, they are using less exploration and more exploitation, where
because they think they already know.
yeah,
They think they already know how to exploit,
right,
so to
right.
speak.
Yeah. And at that point, they basically just more and more often, they just pick the action that, according to their data, is the best action to take. And this balance between exploration and exploitation keeps moving towards exploitation and away from exploration. And then they kind of converge on a certain type of behavior. What is really fascinating, and this is what I was trying to emphasize from the beginning, is not just having this one algorithm playing against the market, but rather having multiple algorithms playing against the market, but also playing against each other. And why is this so fascinating and also makes it, I would say, impossible to predict the outcomes of the process without doing experiments? What makes it fascinating is that the state of the world that they're facing is not affected just by outside factors, but it's affected by what other algorithms are doing, right? So every time, let's say I got a piece of news and I decide how strongly I want to trade. So the piece of news is the state, and how much I want to trade is the action. But then the state is also affected by what the other algorithms have done, because this will determine the market price, and this is what goes into my analysis as part of the state. So you're dealing here with really super complex systems and interactions among different algorithms. And then, once you run the experiment and you repeat this over and over, millions and millions of times, then you get a sense of what kind of behavior they end up converging on. Now, when we talk about collusion, we basically think about behavior that is not competitive. So competitive behavior will be, I got a piece of news and I'm trading full force on this piece of news. This is competitive behavior. Collusive behavior is when it looks like they are internalizing what is the effect they have on others. And so they end up trading less aggressively, which is what would be supported in a collusive equilibrium, as if they were internalizing what they are doing to each other.
It's a multiple issues here. One is market efficiency. Do these algorithms make markets more efficient or less so?
Do they make markets more efficient?
More efficient?
Right. So
do they make, market prices more efficient?
Yeah. Right. So I think we need to separate a couple of things here. There are certainly elements in these algorithms that can promote market efficiency. What I mean by that is just the fact that you have these algorithms that can process information quickly and act on the information means that this will promote market efficiency. However, the key focus of our study, as I mentioned, is this pattern of collusion, whereby they end up trading less aggressively on their information, knowing, or in a way that looks like they are knowing the effect that this will have on each other. This particular feature is making markets less efficient. So what we show in the paper is, you could be interested in collusion for the sake of collusion, but if you're not interested in collusion for the sake of collusion and you want to know what is the effect it has on market outcomes, then there is a very clear monotone relation between collusion, market efficiency, liquidity, mispricing. Higher collusion implies lower liquidity, lower market efficiency, higher mispricing. So that is certainly an adverse implication that is coming with these algorithms and the fact that they converge on this collusive behavior.
So by definition, automated algorithms will make, use a statement, I can object to it, shall make markets less efficient. What do you think?
So they will make markets less efficient only to the extent that they collude, yes. As I mentioned, some aspects of their design can promote market efficiency. When people are thinking about AI, they tend to point out the positive implications of AI, which is the fact that there is more efficient information processing, and this will help market efficiency. I do not take issue with that. Certainly, this technology is helping markets in many ways. What we found interesting is once you start exploring the interaction across these different algorithms, then you don't get the full benefits that you would have gotten because they learn how to collude with each other and essentially withhold some of the information and some of the advances from the market.
Yeah, this is so interesting, Itay. So, intuition will tell us, if there are a lot of people trading in the market on information, that should make markets more efficient. But what you're showing here is that, okay, so suppose there's some with these algorithms trading, they could follow patterns and reinforce each other to the next expectation, and it could go on like that. At some point, it's going to crash. This is sort of a systemic risk issue. So going back to the regulation policy question here, you cannot prove these algorithms are calling each other, setting prices or anything like that. They're just trading on data. And SEC
I will say that they are definitely not calling each other or setting prices or anything like that. So you say we cannot prove that they do that. I will say we can prove that they don't do that.
Yes, we can prove they don't do that. And so how do we think about it? I mean, the risk I keep seeing is a sort of a systemic risk. I mean, because I sort of lived through it, things work for 3-4 years and then everything comes crashing down. And that crash is going to have a lot of bad effects on the whole population, not just this AI things that people have created, right? So how do we regulate these things? I don't know.
I mean, there are many good questions to ask about what is the optimal way to regulate it. And as we discussed, the risk we are highlighting in this particular paper is the risk of collusion, which reduces competition, liquidity, and so on. There's a follow-up question to be asked about what are the implications for market stability and the fact that this can cause bubbles and crashes, and that is a follow-up project that we are working on. In terms of regulating that, I think we are just starting to scratch the surface on that. I would say we point out, for example, that increasing the number of players will help, reducing the degree of homogenization will help. But I think that regulators, when dealing with AI, really need to think out of the box and try to come up with new strategies. And I think we are just starting to starting to understand that. We need more, I would say, more of these experiments because through the lens of these experiments, we can get new insights on what is causing these adverse market behaviors and market patterns. So more of these experiments will certainly help.
Yeah.
Maybe I'll say something here that I think is important to say, and I didn't have a chance to say so far.
Yeah.
Which is in general in economics and finance, when we did research in the past, the vast majority of research has been either theoretical, where you build models and you analyze them, or empirical, where you look at the data and you try to understand from the data what is the underlying behavior. There is a third branch of research that has been pursued in economics over the years, which is experimental. Where instead of looking at the data, which is sometimes hard to do, or building a theory, which doesn't always tell you everything that you want to know, you run an experiment, you put a bunch of people in a situation and you see how they behave. Now, experimental economics has been great and certainly had many achievements, but it's also limited because to run an experiment with people, you need to find a group of people, put them in a room, tell them what to do, and there are a lot of questions about external validity and so on. One thing that is nice when you are thinking about AI players instead of human players is running these experiments is actually much easier because you create the players, you program them.
You can simulate.
And then you see what they do. You see what they do. So you can get a better understanding of what will happen in different market environments. So just to kind of go back to your question, you asked about regulation. I will say more of these experiments, I think, will help us understand what kind of regulation we can feasibly conduct. Our paper, I mentioned two things, homogenization and concentration. Our paper also has other predictions on different parameters of the environment that can make collusion more or less likely. But the more of these experiments that we will have, I think the easier it'll be to make these recommendations.
Yeah, so I am most worried about sort of the brittleness of financial markets. If everybody's seeking patterns, I mean, we've seen this before. Patterns reinforce patterns, and AI is much more efficient seeking patterns than humans. Actually, humans at least have errors in their brains. Mathematical models typically don't. And so it seems to me that we're building in brittleness with AI trading thing. I mean, I don't do that anymore, but I have done that in the past. But I think it's a systemic risk issue. So if it's a systemic issue, let's say I have 50,000 AI agents trading all sorts of stuff. Who is the regulator on this? I mean, who is going to put a constraint on this?
I mean, if you want to think about who can put a constraint on this, I would go to the typical regulatory authorities, right? If you're dealing with the stock market, it should be the SEC. If you're dealing with commodities markets, it can be the CFTC. So I don't think we have a problem of identifying the regulator here. I think the problem is more for the regulator to the stock market, it should be the SEC. If you're dealing with commodities markets, it can be the CFTC. So I don't think we have a problem of identifying the regulator here. I think the problem is more for the regulator to understand what to do. And I would say this has different layers, right? We used to deal with an environment that had human players, and it was already not super clear what was the optimal thing to do back then, but regulators developed a certain playbook of what they're doing. I mean, there were rules and there were the implementation of the rules, but in general, there was kind of a playbook to follow of how to regulate financial markets in that environment. Now, once we are dealing with AI algorithms, it's probably not the same playbook. So whether or not the old playbook was optimal is one question, but the new environment probably calls for a new playbook, no matter whether the previous one was optimal or not. So I would say we need to understand better what the environment might converge to and how best to regulate it.
Do we need a sort of an AI financial regulator? Is it like a different agency? Do we need an AI regulator of some sort?
I don't know if I would recommend having a separate regulator for AI, partly because we already have a lot of regulators, right? So we have a regulator, we have few regulators for banks, and then we have a regulator for stock market, and we have a regulator for commodities markets. And so there is already this fragmentation in regulation that is probably not helping the regulatory environment. So now creating a new one for AI is probably just going to complicate things further.
Yes.
In
I
that
wasn't
sense,
suggesting that at all, Itay. I was just asking the question.
yes. In that sense, I think it would probably be ideal for the current regulators to try to understand it better and do it within their own jurisdiction.
Yeah, so it's like the current systems are good enough, but then they have to have a good understanding of what's happening is the issue. And since technology is advancing so fast, it's really difficult actually for regulators to get on the bandwagon, so to speak, to really understand what the technology is doing, right? So, I mean, we have well, I'm going on a tangent here. We have an age problem. The people from the past don't know what AI is or what computers are and what they're doing, and they're the regulators, and so it is actually quite difficult for them to get on the technical bandwagon, isn't it? I mean, I'm just making a statement here. I'll let you react to it.
Yeah, I think that's definitely true. I mean, I think when you look in the past, it's always been the case that regulators have a hard time catching up with the new innovations in the market. Even if you think about 2008, so understanding securitization and repo markets, there were a lot of complexities with the financial innovation that regulators did not catch up on time, and certainly this affected the severity of the crisis. And we were not talking about high tech. It wasn't really rocket science back then. It was more just all the different products that were emerging from the financial market without new technology per se, but rather just all this financial ingenuity that people were trying to do things in different ways to make more money and kind of overcome existing regulation and so on. So we already had this problem then, and in fact, you probably had this problem throughout the history of finance, that regulators are always trying to catch up, but they're somewhat behind. I would say you're probably right that the problem is aggravated these days, given that You also need to deal with technological issues. And, there are also attacks on multiple fronts, right? So on the
Yeah.
one hand, we have AI in financial markets, but then we have this whole new arena of decentralized finance and digital assets and cryptocurrencies that also is posing a lot of challenges. And some of the issues there are even less clear because you don't even know who should be the regulator. Unlike with AI, I think this is at least clearer. And then, just like we had in 2008 with new financial structures and innovation, we have some of it now as well with private credit that is emerging.
Yeah.
So the threats to the system are really coming across different fronts. So this is certainly a very challenging period for financial regulation. I don't want to
Yeah.
overstate it by saying this is the toughest period for financial regulation, but it's certainly up there in terms of the challenges that they need to deal with.
Completely. Yeah. Yeah. So I have to let you go. So we ran over, Itay. So yeah, thanks for coming back on the show, and I really enjoyed the conversation. Thank you.
Thank you very much. I enjoyed the conversation as well.